Welcome to Show Me the Money with Michael.derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. On today's episode with Danny Flores, you're going to hear a little bit from a gentleman with boots on the ground, growing up in Southern California, working on apartment projects, value-add projects all over the United States. You'll hear about some highs and lows of his career, a little bit of construction, a little bit of value-add on deals, and a little bit from the management aspect. I think it'll be a good episode where you can kind of hear what he's doing day in and day out and what his forecast is of the market. Today's episode has been sponsored by Willow Glen Insurance. Leighton Peterson and his team has been excellent on all different types of commercial real estate insurance across the United States, has never let us down, and I highly recommend using him and his team. Again, Leighton, thank you for sponsoring the episode, and we hope that a lot of our viewers will utilize your services in the future. If you want more information on Willow Glen Insurance, please look at the show notes and you'll find the information there. Thank you and have a great day. Good morning, everyone, and welcome to the 6th episode of Show Me the Money with Michael.derk. I'd like to introduce Danny Flores, Danny is the principal of Prime Capital Investments and other various entities within the real estate arena. PCI acquires value-add multifamily projects. He spent 16 years in the building industry, from building single-family homes to heavy construction, building roadways and waterways. He possesses a Bachelor of Science degree in Business Administration with an emphasis in General Financial Management from the University of Southern California. He worked for Bank of the West, syndicating loans in the middle market arena. He has been buying multifamily assets since 2000, where he had numerous projects go full cycle successfully. He enjoys traveling and boating and has 4 boys and lives in Newport Beach. So Danny, welcome to the show. Thank you for coming on here. I think the viewers are going to be excited to hear about your past, how you've been successful, and also maybe some of the pitfalls in your career as well. So kind of jumping right in here. So what is the last 12 months, which has been a pretty wild time in the real estate world, what does that look like for you? And what things have you done and maybe doing today as well to kind of pivot through this world?
Well, first of all, thank you, Michael, for having me on. It's great to be here and go through this with you. Last year has been kind of a tough year. It's been a surprising year in the sense that interest rates have gone up so fast. We were doing deals last year, and I want to talk about one specifically that we had. We were under contract in May of last year. We go out to the debt market, we go out to the equity market, and we couldn't get any term sheets. And that was a problem because we wanted to do the deal, and we can't get debt on the deal, then we can't get it done.
Right. It
was an off-market deal. We go back to the seller and ask him, Mr. Seller, we want to do the deal, but we need to retrade. We need a lower price. Markets aren't touching it. It was a $30 million deal. We were able to get a reduction to $27 million, wow. And we asked them to carry the paper.
Wow. So 10% reduction, and now you're asking for the seller instead of
yes.
doing what he wants to with his monies on that deal.
Right.
Now he has to take that opportunity cost. So that's a very significant change in the market to do that. So that's okay, great.
Right. So that puts us in a good position in being able to get the debt like that. We got 5% fixed IO, 3 years, so we couldn't ask for anything better.
It's the cheapest bridge loan you're going to get.
Exactly.
Yes.
Right. And so we go out, we do a due diligence. We're pushing the deal through. We're bringing in institutional money for that. We had a $15 million raise on that. And 2.5 weeks prior to closing, on our extension, our equity pulls out. So now our back's up against the wall.
Wow.
We have $350,000. Non-contingent.
Oof.
On the line. We want to do the deal.
Right.
But what do? So We go back.
Why did the equity pull out?
There were sales of buildings next to us.
Okay.
They were watching to see if that sale happened to build a strong comp for the building.
Got it.
They couldn't sell it, and it got him jittery. And I understand, right? You know, they're like, hey, what's going on with the market? We don't know. We'll stand on the sideline.
Got it. So the equity thought you were potentially overpaying for the asset.
Potentially.
Right. But who knows? This was last. You said last May of last year.
So
no one had any idea.
We're in the middle of summer now. Towards the end of summer.
Yeah, right.
You know, it took us about 6 months to get this deal done, going back and forth.
Got it.
We go back to the owner a second time with a tail between our legs and say, hey, Mr. Owner, will you give us a second reduction and still carry the note? So the first time he was going to carry $20 million of the 27.
Wow.
He comes back and he says, I'll do it. He reduced the price another $3 million. Carried the note.
That's a very motivated seller you found.
Yeah, I mean, he's a good guy to work with. Yeah.
So it cost him $6 million to effectively sell the property. And what was the reason for the sale of the asset? Why was he selling it?
Well, he was selling it because they have other assets in Texas and they have other assets in Washington, I believe, or Oregon. And there was one outlier that they had.
Got it.
And they said, well, we don't want to be in Arizona
So reconfigure
anymore.
their portfolio and move the assets to economies of scale for management and ownership. Okay, got it.
And they self-managed. It's our typical value-add deal.
Sure.
They self-managed. You know, we asked for statements, and they were on Excel. They didn't have management software. They all the units were classic.
Okay.
So they kept them filled, and they took care of the building. But we're coming in. We're going to renovate, and we're going to push to market rents.
Right.
Right. And so he did, you know, he gave us an extension. He reduced the price to 24, and he wasn't going to carry 20 million this time though. This time he reduced that to 14.
Okay.
And he raised our interest rate to 6. Still fixed, still IO, so
still
it's not bad.
Relatively speaking, not bad at all.
For a bridge, I mean, that's the best bridge loan you can ever get.
With no prepay, or was there a prepayment penalty?
I don't think there is.
Wow.
Yeah, we can prepay at any time.
That's a phenomenal deal.
Yes.
That he was still sticking with you.
Yeah.
I mean, given this time, as interest rates are going through the roof, the uncertainty is there. Most people have pencils down. You know, there's really the market's starting to stall out.
Yeah.
And he's staying with you. You're non-contingent.
Right. Yeah.
He could have taken that money and ran. So, I mean, the perseverance that you had to go through that, the gut check that you had to do probably on a nightly basis to make sure that, you know, you're still and you got to be questioning yourself too during this time last year, you know, are you overpaying? Right? Are you getting a good deal? Are you? You have no idea. You're literally swimming in the dark and hoping that you're going to come out alive at the end of this deal. So,
and then the other difficult part is that it isn't a real bridge loan in the sense that we have to raise the money for the capex.
Wow.
So we have to be well capitalized to be able to push through because we know we're not going to a lender and saying, hey, we need a loan to do capex. We're not doing that.
And how much were you going to be putting in renovation per unit?
We're on that building. We're putting in about $19,000 per unit.
Pretty significant lift.
Yes, all new cabinets, countertops, stainless steel appliances. The only thing we're not doing is installation of washers and dryers, and that's because the configuration of the structure raised the price, hooking up all the sewer lines, and we couldn't make it work.
Got it.
So, but everything else is new. Outside, new paint, rebranding, everything else. We have projected to finish that renovation 16 months after acquisition.
Okay. And what was the income going in when you bought that versus that pro forma? Like, what was?
Oh, well, we'll probably double it.
Double it?
Yeah, we'll probably double it. I don't remember the numbers off the top of my head, but we'll.
But percentage-wise, you were going to double the income?
We'll probably double the income.
Got it.
Yeah.
Wow. Well, it's a very trying time, but the most successful people I've seen in the business obviously persevere through those times of distress. And obviously the seller knew that you were a real buyer, be able to step up to the table and execute and get done. So that's excellent. Yeah. And your investors probably were pretty nervous all the way through too, especially taking 6 months. Yeah. They're like, well, every month goes by, maybe I should pull my money, maybe I should do that.
Yeah.
You know, the stock market's going down. I mean, it's just, you know, it's just a world of uncertainty. So to persevere through those times is Obviously, what I've seen very successful people do.
It wasn't an easy raise. It was not. You had to
Right.
call, and people are pulling back, and maybe yes, maybe no, only do half. Yeah, it was tough. It was tough.
The seller thinks the property's here. The buyers are,
Yeah.
you know, I'm not sure what the value is. The lender's like, any excuse to get out.
Yeah.
Equity investors. So
Yeah.
that's interesting. Moving on, can you share a little bit about your outlook on interest rates and opportunities in the multifamily market? Maybe let's talk about the second half of 2023. We know obviously that's everything that's happened, and all of our viewers can kind of understand and read the newspapers, which, you know, isn't news. It's already happened. But forecasting, looking at the next, say, 6 or 7 months here for the remainder of the year, what are your thoughts on what's going to happen and how it's going to be affecting real estate, primarily multifamily assets that you're involved in?
Well, what we see is the rates probably aren't coming down anytime soon. So that's within the next 6 months. We don't see that happening. Where we see is a huge disconnect between us buyers and sellers coming to terms on what the valuation of the property is. So it makes it difficult when we go out and we start underwriting deals because pricing is 10, 15, 20% below what the sellers want to sell at. Makes it difficult to buy. The other half of it is that there are people that have debt coming due. And we are actually starting to see deals come to us, and they come quietly because they're not really announced. But we get deals coming in that they are willing to sell for less than their cost basis.
Well, that's great. Well, they probably have debt between 3 and 3.5% that we've helped a lot of these clients put on over the last 3 to 5 years. Now that debt's looking at between 6 to 7%.
Right.
You double the debt load. If you haven't stepped on the gas pedal, increase your rents to market, that's going to be an issue. So either they do a big cash in refinance, or these assets will have to sell, which there still is a lot of equity in there, but based on debt coverage on today's underwriting, a lot of these deals are not debt covering if they haven't refinanced a deal in, say, in the last 12 to 24 months. So those will be good opportunities, and we'll be able to capitalize on that. We're also seeing different wrap structures come in, the seller carrybacks, the assumability of notes too on some of these bases, I think will be great opportunities, or people just getting out of markets in general. I think like that client that you were talking to and that you execute on the deal, moving into Washington and Texas, getting out of Phoenix, people getting out of California, people coming back into California because sometimes the roses aren't always smelling as great as they look on these pictures when you go into these new markets and pioneering on that basis. So maybe if you can touch on a little bit about maybe what markets you're actively in right now, where do you see the most growth from your perspective, and what markets are you shying away from? Maybe if you can touch on that a little bit.
Okay. Well, we're very active in Arizona. Reason being is we've been able to develop good broker relationships, so we're able to get off-market deals coming to the table. But also we like the market because of all the job growth and all the businesses that are there. If you go to, say, Phoenix, all you do is see nothing but tower cranes building everywhere.
Right.
And there are a lot of those are Class A buildings that are being built. They don't compete with us because we're more on the B and C side of the spectrum.
Got it. Okay.
And so, there has been syndicators that have gone in and have turned a lot of the buildings in Phoenix, but it's a patient game, right? You just have to wait for the right situation. Somebody passes away. Somebody just wants to retire out. And they go to the brokers, and we're able to pick up deals. We are also active in North Carolina. Not as big as Arizona, but we have deals up there near Charlotte.
How did you? That's all the way across the country for you. Yeah. So just to be able to fly there and get there, it seems to be a pretty big challenge. And as far as management, how did you choose? Was it Charlotte, North Carolina, or what part?
Near in Hickory, which is about 50 miles north.
Okay.
And how we landed there is just a partnership. We developed a partnership with another family, and we work well together. They're more boots on the ground. They're established there, and that's how we became partners there.
So almost more like a joint venture with local.
Venture, yeah.
Okay, because it's hard to pioneer going into these markets.
Yeah. Why would we just fly out there? Yeah.
Right. Exactly. Yeah. To go and, especially if you're not competing with the largest players in that market,
correct,
and you're buying these deals and getting deals, it's like, what are you missing?
Yes.
economics, what government intervention could be happening. There's a lot of pitfalls that could happen going into new markets. That's why it's key to team up with local professionals that have been there, resume, good experience, and that way I think it really would benefit you, which obviously it has.
Right.
So you got Phoenix, you got North Carolina. What else?
I spent about 3 weeks ago. I spent about a week out in Denver. Denver. We're looking at Denver as a potential city to get in.
Yep.
Talking to brokers, looking at deals, getting to know the area.
That's been a rock solid market, especially Aurora and the surrounding communities.
Yeah.
Very low inventory, low vacancy. Rents have gone through the roof.
A lot of building, a lot of new. It's amazing how much building is going out in Denver.
In Denver, yes.
Yeah.
Great job opportunities out there.
Yes.
So it's we've done a lot of business out there, and that's been a very strong market.
Kansas City, we've heard of Kansas City, so we want to get out there and kind of see what all the news is about.
Right.
Get to explore that one. We're not buying in California, even though I started out in California about 20 years ago.
What's the reason? Why not California today?
Well, with AB 1482 makes it difficult to go in there and do the type of value add deals that we do, renovate, vacate the tenants. It's a little difficult where we don't have to fight that battle. If we go down to Arizona, it's easy. Give them a 5-day non-renewal, 30-day non-renewal, and you can get them out. You can, if somebody doesn't pay rent, it's so much easier than in California. Yeah,
tenants have a large upper hand here in California. There's certain other cities across the country that have a pretty big upper hand, so that's very difficult for your business for sure.
So that's not to say we won't buy anymore in California, because we just did up in Salinas. There was a deal that came up off market. It had like a 9% yield on cost.
Wow.
So we could not ignore that.
Right.
We tried to get it. We did it, but we still tried.
Understood.
So something like that will pull us back in.
Okay.
Right?
Got it. But you're just not actively looking for it, but you will do deals here when the right deals present.
Well, we know the market, right? We know the market, the California market, but they have to be juicy enough to be
well, especially with the government intervention here being so heavy-handed, you have to kind of almost price that in for a little.
Yeah, absolutely.
There's a lot of risk, especially Prop 13 that potentially could be at risk here. Those are some very, very heavy factors if that goes away.
Yeah.
Not if you're acquiring properties, more so for the people that have had properties for a long time. If they're not considering that Prop 13 could go away, you have a $50 million asset and your taxes are $100,000 a year versus what reality could be reset at market rates today. That could wipe out a significant amount of cash flow. So it's time will tell what will happen here.
We have to see, right? Just kind of hold and be careful. And it seems like it's easier to navigate in Northern California than SoCal a little bit. All the rules, City of LA, County of LA, Inglewood, Santa Monica.
And the moratoriums just seem like they're going on forever. And, it's even buying out tenants is not as easy as people think it is, where a lot of these tenants have become very sharp and sophisticated, and they understand
everything's online.
I'm not going anywhere for $150,000. You're like, oh my goodness, like that's a lot more than I anticipated in my budgets and buyouts. But when you do get that tenant out of there, that increase in that rent exponentially increases the value of the property as well as your cash flow. Recapitalize it on a refinance with tax-free money coming out. So. One other point I wanted to touch on too. You previously owned a management company and recently sold that business. Maybe if you can share, why did you sell that company, and was it successful? Were you happy you were in management? Obviously, you have such great experience and such great background in construction and everything. You have been boots on the ground, which I think the most successful people I see in the business are truly the boots on the ground. They really need to see it firsthand in any business, not just real estate. Any business, I really feel that if you're really not in it thick and thin, you'll just at the whim of the market. And if you're not with your thumb on the pulse there, I think that could be very challenging to be successful for the long run. You might be able to be good for the short term, but the long run, if you don't have your thumb on the pulse, whatever you're doing, especially real estate, I think it's critical. So maybe if you can just touch on that a little bit in the management company and talking a little bit about your experience on that.
Yeah, so the management company, I opened it up in 2006, started it from zero, was able to build it up. It was much easier before AB 1482.
Okay.
before COVID kind of changed everything, work from home, and so running the acquisition side that we do as well. Having both of them on my plate, just kind of, I decided I don't want to work as hard in a sense. Not that I'm not working hard, but I was just separating too much of my time.
Maybe you wanted to work smarter, not harder.
Exactly.
Is that kind of okay.
Exactly.
Got it.
Because we hire third-party management for all our deals, and I also saw how much easier it is to manage your own assets that way. So the right buyer came, and we made a deal, and I ended up selling it off, and it was a good move for me because it's like I removed a big workload off of me.
Yes.
Kind of gives me 100% efforts in proceeding with the acquisitions that we do.
Got it. It's hard to be good at both,
realistically.
It is,
but it gave me the experience, right? So I can sit with the management companies, and we can structure the deals, we can structure the management, we can structure the budgets, the business plans. And so having that skill set is by far very valuable for me.
Now you know how to manage the management company, which is key.
Yes.
A lot of people have professional management on their properties, and they think they're doing them a service. But a lot of management companies, unfortunately, we see out there, they all start off pretty good at the beginning, but tend to kind of peter out a little bit, or they're just managing a top line. They're not managing the expenses. Where I think some of the greatest things that we should be doing is managing the bottom line.
Oh,
right?
For sure. Yeah.
Paying the mortgage and paying the bills and the investor rate of return is based on the bottom line, not just top line and expenses. So we see that a lot of our clients that have professional management, unfortunately, and if you don't have the economies of scale, right? If you don't have 250, 300 units, it doesn't make sense to manage things on your own basis.
Right.
So you need to bring in that professional management, pay them that fee. But a lot of times, there's turnover of staff or whatnot. I mean, you could have it on your own company too, but management is everything. Like we've talked about many times on the show, over the several months, the management is imperative to be successful.
To give you the results that you're looking for, absolutely.
Yes.
And being able to tell them how you're going to cut and how you're going to manage the expenses, and some of the variable expenses could be the maintenance expenses.
Yes.
So what are we going to do? How are we going to do it? And can we just do it in steps versus all in 1 month?
Right.
Take the hit throughout the year, spread it out. So stuff like that, it kind of helps us.
Sure. Yes, 100%. Maybe if you can talk a little bit about some of the highs and lows. I know you talked about that one deal, but maybe if you can kind of talk about your career, over the time that you've been, investing and being in real estate, maybe talk about maybe the high point, and maybe talk a little bit about maybe a low point or two, so that, some of the viewers can kind of learn that this is not just a get-rich-quick business. This is not something that happens overnight. And, a successful business person like yourself in real estate, maybe if you can touch on that a little bit about the grit and the grind of what it takes to be successful.
Okay. High points I've had, been lucky enough to have multiple high points. High points, I would define them as being able to successfully close a deal, execute the business plan, and execute the exit. Usually we execute our exits. We underwrite at a 5-year execution plan, exit plan, basically. But markets have been good to us, where we can do our exits. We've done them in 2 years, 2.5 years.
So you're hitting your IRR, your rate of return, in 2 years, but you have a 5-year horizon to hit that mark.
Yes. And then the other half is being able to execute a good business plan where you can increase the NOI faster than you underwritten it for.
Okay.
We always try to race against ourselves, right? Let's see, we underwrote this way, conservative. Let's beat that and kind of over deliver for our investors.
Okay.
So those are high points, because in being able to go back to an investor that puts, say, $100,000 in the deal and give them $200,000 back, that's the greatest thing ever.
That is great.
Right? They're like happy. They're happy.
Especially they weren't even doing the work themselves. You were doing all the work, which is great.
Yes. And we use a lot of retail investors, and those are defined as just regular working people that have, it could be lawyers, it could be doctors, it could be just regular people that have money sitting in there and say, hey, you make more money for them. So you're changing.
But they don't have the wherewithal. They don't have the connections of the brokers. They don't have the management experience. They don't have all the connections. They don't understand all those variables. So to be working on your day job every day and to be able to invest that money, turn it into 1.5 or 2 times is excellent.
Yes,
and for you to quickly expedite the process and do a 2-year time frame on that deal versus a 5-year time frame, that's an opportunity cost for you, because now you can reinvest and redeploy that money again and do another deal, which is great for you and the investors.
Absolutely, right? You know, I mean, five years is great. If you do it faster than that, that's even better, right? So that's the satisfaction we get out of that. Now, low points. I have a story, you know, back early on in my career when I was a contractor. That was the late 80s, early 90s, when the aerospace industry just tanked in California. And I was building homes and doing home additions and whatnot, remodels, and money dried up overnight.
Right.
And what it did, it basically put me in the hole. I didn't have any work. I owed like $100,000, and I had to figure out how to dig my way out. This is like 30 years ago.
Right.
But I always said it's better to fail now at a young age.
Yes.
You know, no family, no kids. It's just you, right? All you got to figure out is how to eat.
Sure.
So you got to figure it out. You got to work through it, and it kind of teaches you. It teaches you to be careful. Teaches you to be wiser. And teaches you it's not an easy business.
No, it's not at all. It's definitely not.
Right.
Well, thank you for sharing that. And that's, again, many of the most successful investors that we worked with and people in the industry have all had low points. And that's, thank you for touching on that. And, you know, a lot of us in our career, people just see all of the accolades and all the awards that we get. But in reality, there's a lot of low points and a lot of grit and a lot of, you know, painful nights and sleepless nights to get to where you've gotten today and the success you've made over the years. So, again, my hat's off to you, and I appreciate you talking about that. Maybe kind of on a wrap of the show here, where do you forecast the market over the next 6 to 12 months? Where do you see the biggest opportunities, and where are you going to be focusing on for you and your investors?
We see opportunities in the sense that when the interest rates go up, prices come down. They have to, right? At one point, they have to.
Unless income is offsetting.
Correct.
Right.
Right. Other factors, right?
Right.
Other than that, we're looking to buy.
Okay.
We think this is a window of opportunity to continue buying. We want to buy as much as we can. Naturally, it's harder to buy because of the pricing, but we think the sellers have to get used to that. When years ago when I started in the business, interest rates were at 8%. Cap rates were coming in close to that, much higher than 5 and 6, to make the deals happen, and everybody was content. So the mindset has to change one way or the other. If we can buy deals now, we think that whenever rates change and come down, the valuation of those deals will increase. It gives us the time to execute our business plans, to stabilize the buildings, and to have them ready to sell. That's what we're going to do, or refinance, whichever the case may be, when the markets change. Now, we don't know when they're going to change, but the window of opportunity, I think, is here.
Yes. Okay. Excellent. Well, I couldn't agree more. And to be able to capitalize when interest rates do come down, refinance, take out that tax-free money, right, on a refinance basis, and redeploy that into other assets will be great for you and your investors. So, well, thank you. Thank you so much for coming on the show.
Yeah.
I really appreciate it. And hopefully everyone here in the audience really enjoyed hearing some more tips of the trade, whether they're, again, getting in the business, have been in the business a few years, or a long-term veteran. I hope that this show has been beneficial. And Danny, thanks again, and I wish you continued success
Thanks
everything in business and life.
Thanks for having me.
Thank you.
Yeah.